So in this video, we're going to be looking at some chart patterns that every trader should really know about. In day trading, you can use them as a swing trading strategy. You can use them as a position type of trade when we're talking about the cup and handle. So let's get started. So the head and shoulders pattern, this is the first one we're going to talk about. This is a classic pattern. Everyone knows about it. Essentially, a reversal pattern signals a potential shift from a rising market to a falling one, or vice versa, when we're talking about the inverted head and shoulders. So we're looking at three peaks: the left shoulder, the head, and the right shoulder. And generally, traders will sell the head and shoulders once we break the neckline. And that's when this pattern would confirm. So you want to consider that the head and shoulders actually shows the structured definition of a trend. It's making higher highs, higher lows, higher high. And then we start getting into a change of trend. And when we see the break of the neckline, that shows us a lower low is coming. So we put in our lower high. We're starting to put in our lower low in this area right here. Now, this is a perfect definition of a head and shoulders pattern. Unfortunately, life doesn't treat us perfectly. We generally see stuff like this, and essentially this is a head and shoulders pattern. We have our left shoulder, our head, and then from there, we have our right shoulder. Now remember, as long as this pattern on the right side doesn't break above the high, we're still looking at the pattern. It doesn't invalidate it. Just assume that if it's close enough, and that is the pattern. It doesn't have to be picture perfect like we saw. And really, we just draw in there's our neckline here. And when price breaks here is when people will short it. Now, my preferred way of trading these is actually trading at the right shoulder. And this one's a better definition of what I'm talking about. It's perfectly across here. But generally I look for, on the right shoulder, we get a break of the left shoulder resistance area and then a rejection. It's not perfect here, but we want to see what we call an up thrust, which is where price will break above and then immediately break below. That gives you an earlier entry, and then you're already into the trade before it even breaks the neckline. And the stop, absolute definition above the swing of the reversal candle that's here. It's not a bad pattern when you can find them, but again, don't look for perfection. So now we're going to talk about flags and pennants, but we're going to stick more with the flag. And it just looks like a rectangle, slopes against the current trend. Now a pennant's a little bit different. It's like a compact symmetrical triangle. But anyways, now both of these will suggest a brief pause before the original trend resumes. And you want to watch out for a breakout of these, ideally with increased volume. If you're an FX trader, you want to use FX futures. And again, we get this leg up with a gap, then we get our pullback. I just refer to it as a pullback. Keep it nice and simple. But again, just like the other one, they don't always look perfect. So for here, one of the defining characteristics for me when looking for flags is the original move upwards, which is this leg here. You want to see, is there persistent buying here? And generally there is here. We don't have strong wicks against us. And then we get the pullback, and all we do is this, and that would be our flag. Then we're looking for a breakout to the upside on increased volume. If you don't have volume on the actual break, you certainly want to see volume coming in after, which we do here. We do get some volume here. Price rolls up about 1%, another 1.5%. So we do see increasing volume in here. Not a bad little entry on this particular trade using a flag pattern. So again, you want to see a nice strong leg up. That's your first clue to look for a flag. And then we get a nice orderly consolidation here, pullback on it. Now we're going to look at double tops and double bottoms. Another reversal pattern. When you're looking at double top, we're looking at two peaks at roughly the same price zone. It does not have to be exact. And that just indicates the uptrend may be running out of steam because the buyers can't push it even higher. Double bottom, you see it right here, a low, and a move up after it breaks the neckline. If you wait until it breaks the neckline, you've increased your risk. But the key is to watch for that second peak or the valley to break the level of the first one, right? That's 100% confirmation. And volume is also important. When you're looking at these, you want to see lower volume as the right side of the double bottom, for example, is put in place. But again, let's take a look at what they really look like. And they're not always pretty. And we can see it right here. There's a peak, draw your line across. One of the keys we're looking for when we're looking for double tops or double bottoms is that there is some move away from the bottom or the top and then a retrace back into it. That's what we're seeing here. And are we seeing lower volume? We certainly are. There's high volume here, lower volume in this area right here. This doesn't go very far. And you also want to take trend into consideration. On an uptrend, you want to be looking for double bottoms for reversals back to the upside. But if you want to look for an earlier entry, so we're going to use this example here. Just like we did with the head and shoulders pattern, we're going to look for this up thrust right here where it breaks and is rejected. You would put your entry just below the reversal candle. Your stop is well defined right above here because you certainly want to be out if this is happening. Some traders will even bring it in a little bit into the actual wick. And it's a short trade to the downside on a reversal. So again, these are just earlier entries. If you're waiting for this to break, it never broke and you wouldn't be in this trade. So that's the key to these, is looking for the one peak, a bit of a valley, a revisit back to the zone of the first peak, and a reversal down. Earlier entry would be on a reversal after an up thrust for a double top. Conservative would be a break of the neckline. For those that want to be a little extra cautious, off the double bottom, we do get the break of a neckline. Maybe you don't want to trade that. You wait for the pullback to the neckline zone, and then you get a move up. The key when you're looking for pullbacks is you want to see lower volume during the pullback. We do not want to see momentum against the original move up, which you can see is a little bit higher volume. Now let's take a look at triangles. These often appear during a consolidation. I call anything that's tightening of price action just a consolidation. Keep it nice and simple because I'm not going to trade them much differently. So we're going to look at an ascending triangle, and that's just where we have a flat resistance line and an upsloping support line. It's quite simple. These are pretty common, and I like these because you can look at this and you know that they're still buying interest even though price isn't going higher. That's a good sign. I'm not going to get into the descending triangle, just the exact opposite of this. The key is we just need to see increasing buying pressure on these patterns, and that's what we see because people are buying in at a higher price. They're not waiting for it to drop down. That's always a good sign, and those are the kind of trades that you want to be on. But we're going to talk about the symmetrical triangle. I'm going to talk about that one the most, simply because the symmetrical triangle, it's different. It has a converging upper and lower trend line. It shows a tightening range. But here's the problem with these, and they're difficult to trade. All right, so you see that price is congesting together into what they call the apex. With these, unlike the ascending or the descending triangle where we can see some pressure, with symmetrical triangles, there's no hint of a directional buildup like we see. So these are the patterns you do not want to fade them, which a fade is simply if it breaks out to the downside. Well, this is a perfect example. Price breaks to the upside. If you trade that, it comes down the downside. If you trade that, you see price pulls back against you. And most traders would just get out. So it's hard to trade these in this way. Safest bet is to wait for any sort of mean reversion and then take the trade. Right? These are tough patterns to trade, regardless of the trend direction, because there is no directional bias. Our last pattern here is going to be the cup and handle. And it's a bullish continuation pattern here. Let's take a cup with a handle. Here's the cup, here's the handle. These are hard to find. These are not very common. So I'm going to use an image on this one here. We don't want to see too deep of a cup on these. You can see it's a long-term consolidation of price. And what we're looking for is as price starts to rally back up the resistance zone, price pulls back. What's the key to these? Again, on any sort of pullback, we want to see low volume. We do not want to see strong momentum against these pullbacks, which we do not see here. We see declining volume after this big volume move up, declining volume, and on the break, we see increasing volume. Now, keep in mind, the rule of thumb is to look for higher volume on a breakout. The problem is you want to see higher volume also after the breakout, which we don't really see here. We see a consolidation of price. And then we finally do get that breakout. And actually, it's a pretty large move. And again, volume, it's important, but you've seen breakouts on low volume that just fly. So context matters. But this is something you would look for during a longer period of consolidation, a consolidation period of at least a month. These are almost like a brand new trend is forming. So if you can find these and you can trade these, you can look for some bigger moves in price, which will increase your account size. So really, to increase the reliability of the breakouts of these patterns, you want to look for some sort of news or some other incitement that's causing the price to break out. Right? This is going to ensure that you're actually riding a wave of interest. And you could see gains of 20%, 50%, 100% moves. Okay, but there's no guarantee of that. And you do not need that news breaking for that particular instrument you're trading, but it certainly does help. And recognizing chart patterns like the head and shoulders, the flags, the double tops and bottoms, these can give you an edge in trading, but they certainly do not guarantee any sort of outcome. But when you can understand what's going on inside the pattern, like we do with the ascending triangle, where we can see buyers are still buying, even though price is not going any higher above the resistance area, but they're still interested in it, that's a good sign that we could be looking at a pretty decent breakout. You can confirm with other indicators, of course, especially volume before taking a position. Just make sure that you manage your risk with stop losses. And most important, you got to stay disciplined and stick to a trading plan. Design a trading plan around these type of trading patterns. Thanks for watching.